Good morning, everyone. A warm welcome for all of you. I'm Jitendra from ICICI Bank. At ICICI Bank, we have always tried to bring our customer the information and the insight to help them to take the financial decisions. As today's seminar about the tax planning and the budget impacts on the taxes will help you to for the better tax planning. With us today we have Mayur Shah from ENY LLP. He is a tax partner. He has expertise about 24 years experience in the direct taxes and for the tax aspects of the multinationals and domestic clients. He has a hand-on expertise on handling the matter for the personal and the corporate taxation. He is a member of the Institute of Chartered Accountants of India and many professional bodies. He is an eminent speaker for trade industries and chambers, and he will present his views on the personal tax matters and planning aspects to you. Mayur will take us through basics of the details of tax plannings and the budget impact, which will help you for your tax plannings and the tax decisions. Before you plan for before we go for the webinar, there are basic aspects of the webinar I would like to bring to you. In case you have some technical difficulties during the webinar, please call on the number which is given on the slide, or send an email to us, so we will assist you to remove the technical difficulties. In case you have any questions or queries, please write to us on the email IDs given, or on the technical on the question box given on the screen. And last but not least, please do give us the feedback about this below the screen, which will help us to bring out more such kind of the webinars for you. Okay, with this I will request Mayur to start with his presentation on the tax planning.
Yep. Thank you very much, Jitendra. Good morning, all of you. Thank you for sparing time and coming on the webinar. We really appreciate your time to join us on this webinar. With this, let me start what we are going to cover today during the discussion on the webinar. The points which we are going to discuss is about tax planning and the budget impact arising on account of proposed finance budget by the Finance Minister, Mr. Arun Jaitley. During this discussion, just wanted to highlight few points. Is that while we are discussing general guidance on tax planning. However, the tax planning is a specific aspect of fact of each individual, which could differ from individual to individual, and therefore before implementing any such advice, it is advisable that you reach out to your tax consultant, take a proper guidance from him, and then implement. That would be very, very helpful to you to meet your specific requirements. With this, let me start my presentation in relation to tax planning and what we are going to cover, what we mean by tax planning, how we can draw up a difference between tax avoidance, tax evasions and tax planning. What are the current opportunities which are available in the law? How we can make effective use of it? How do we optimize the tax liability or minimize the tax liability to achieve better results out of this? With this, we just wanted to cover in terms of tax planning is an aspect of 3 steps. First, what one has to understand is that they should plan their expense investment in a manner which minimize the tax liability. However, without changing or changing the main objective of financial planning. If financial planning changes, in that there could be a tax implications, and therefore one should just try and see that overall objective of investment planning does not get impacted by way of tax planning. And various other aspects needs to be considered, such as appetite to take a risk, how much you want to invest in safe securities, how much you want to invest in risky securities, or how much risk we want to take. Depending upon that, one can do an investment planning. With this, what we mean by tax planning, what we mean by tax avoidance, and what we mean by tax evasion. I think tax planning is whatever is permitted within the four corners of the law. If one tries to put a structure around it, is considered to be a tax planning. Whereas tax avoidance would mean avoiding certain facts to be provided to the tax office or to the while filing your return, or misrepresenting any of your facts could trigger a tax avoidance or evasions. Let me explain this by way of an example. Mr. A has a plot of land which is being sold by him for 1 crore, and A wants to reduce the tax liability arising on account of sale of plot. Now there are a couple of ways how one can do it. One, where he only declares 50% of the consideration and balance 50% is received by way of cash. This would be regarded as tax evasion. However, instead of doing that, the entire 1 crore is being received and declared in the return of income. However, appropriate investment, say in a residential property or buying a bond as permitted under the tax law, would consider to be a tax planning. Whereas, if this entire sale deal is structured in a manner where the property is gifted out and other consideration is received by way of a gift, so this cross gifting could also be regarded as tax avoidance, and hence one has to be very careful in terms of what should be considered as tax planning and what is being considered as tax avoidance and evasion. Now the question arises that why are we discussing tax avoidance and evasions, and I will come back to that just in a minute. But before we start that, let us understand what are the tax implications, why we are looking at tax planning, and what are the means of it. So first, when any income is received, either income is exempt from tax or it is taxable. Now once the income is taxable, in that case, what is the income which is subject to tax? Whether the amount received as income is subject to tax, or is there any other mechanism to derive taxable income? However, to derive a taxable amount of income, it has to be categorized in various heads, and there are 5 heads prescribed by the law: salary, business and professions, house property, capital gains, and anything which does not fall in all these 4 heads will get categorized as income from other sources. What it does, it provides method how to compute taxable income, what are the deductions or exemptions they are entitled to, and accordingly the taxable amount is being determined. From the taxable amount in aggregate, what one has to do is reduce the permissible deductions which are available or rebates which can be claimed, post which what we will arrive is the taxable income on which tax needs to be calculated at the rate prescribed under the law. This is how the tax computation or taxable income is being determined. However, only when determining the taxable income, one can see that where are the tax planning avenues and how one can make effective use of it. While doing tax planning, what we have observed that there are 3 methods of doing a tax planning. One, where we are able to claim eligible exemptions or not. Many a times what we have seen, there are so many exemptions which are available in respect of specific stream of income or specific components. which are being claimed or not claimed. The certain claim can be made by obtaining certain evidence or by making appropriate investments. The other aspect is that claiming certain deductions on account of making specified investments, buying some insurance policies, or incurring certain expenditure or expenditure which are incurred are being claimed as deductible from the taxable income. The other aspect which is always being missed, that many a times using the method of tax avoidance or evasion, we will end up in paying either litigation cost or we are incurring penalty and other implications or penal consequences, which can also increase the tax which is to be paid to the exchequers. And therefore, it is very, very important when we are considering tax planning, do not only focus on how to minimize tax, but also see how we carry out compliances so as to avoid any additional penal consequences which can result into a further cash outflow from the taxpayer. With this, let me start with that what are the various methods of tax planning in respect of various heads of income. So, let me start with first income from salary. Income from salary, I think compensation generally is being structured or being provided in different methods. So, one, we receive basic salary, then housing rent allowance, medical assistance, leave travel assistance, and various other allowances being provided. Apart from that, there are also retirement contributions being made by the employer, and equivalent contribution is also made by the taxpayer. Now, housing rent allowance, how it helps? If a person is paying rent for occupying an accommodation and he is receiving house rent allowance, such house rent allowance, one can claim exemption in respect of that. The rules are prescribed for that. Generally, it is 50 to 40% depending upon the city where you are residing in. One can claim exemption based on certain formula. Similarly, medical reimbursement or medical assistance being provided by the employer to the extent of 15,000. This is not subject matter of tax and no tax needs to be paid thereon. Similarly, leave travel assistance being provided by the employer. However, if these expenditure are incurred in respect of travel expenses would only mean travel fare, nothing else such as accommodations or any other aspect are not to be covered therein. This is eligible for deductions or for exemption. However, one needs to note that this travel has to be conducted only within India and not outside India. The second aspect is that this is available twice in a block of 4 calendar years. It is different from the tax year and one has to make a note of it. The current block is ending in 2017 and the next block will start from 2018 till 2022. In that block one can claim only 2 times leave travel exemptions, which is not subject matter of tax.
Mayur, here when we are talking about the block of 4 years, it is a calendar year or a financial year?
See, it's a very good question. It is a calendar year and not the tax year. So, when we say a block of 4 years ending on 2017, means it's a calendar year 17 till 31st December 17 the block will be live, post which another block will start from 1st Jan 2018. Yeah. Now, another aspect which we wanted to bring was in relation to PF contribution. What happens is the person who is drawing salary more than 15,000, it is not mandatory for them to contribute to provident fund. I believe it's a better tax planning tool, because what happens is that contribution made by the employee is subject to deduction under chapter 6A, that is under 8IC, up to 1,50,000. So to that extent investment is made, the income arising on such investment is also exempt when income is earned or when the PF is withdrawn. The other aspect is that employer also makes a matching contribution to the extent of 12%, and that is also exempt from taxation in the hands of employee. It is also not taxable when it is withdrawn. So basically PF, one participates in PF, the method which is being followed is at the stage of contribution it is exempt, at the stage when interest is done it is exempt, and when it is withdrawn it is exempt. So this remains untaxed forever. So this is a very good planning avenue, I believe.
Mayur, on the
Yeah.
withdrawal of the PF, whether there is any lock-in period is applicable, or employee can withdraw PF at any point of time after claiming the tax benefit?
Yeah, so it's a very good question in a way. What happens is that PF is governed by statutory provident fund. What it says is that when a person resigns from an organization and does not take up any employment within 2 months time, he can choose to come out from the membership of PF and he can withdraw at that point in time. However, everyone needs to note that if person has not completed 5 years of services, then such withdrawal will also be subject matter of tax, and therefore if contribution is not made for 5 years, it may so happen that whatever withdrawal is being done is subject to tax. Yeah. So moving on to, there are other allowances which are being paid, such as conveyance allowance, which is exempt from taxation up to 1,600. There are also meal coupons which is being provided by the company, up to 50 rupees per meal is exempt from taxation. Likewise, there are several other exemptions which has been provided under the law, and if compensation covers those aspects, those are not subject to tax. One important aspect which we need to note is that per diem which is being paid by many companies while a person is traveling, and these which we have seen in IT companies, pharma companies, or the person who are required to travel frequently. However, such per diems are exempt only and only if it is being spent. If it is not being spent and being credited to the bank account, would be subject to tax, and accordingly everyone needs to make note of it, that the amount per diem which is being spent, appropriate evidence also should be kept on record. It can be demanded by the tax office any time during the assessment proceedings which are going on. With this, we will move on to another key budget changes which has been announced in respect of National Pension Scheme. What has happened is that National Pension Scheme, when employer and employee both are contributing to the National Pension Scheme, the withdrawal is possible only upon achieving the retirement age. However, in 2016, National Pension Scheme was amended to meet certain critical requirement, such as expenditure to be incurred for illness, for marriage, or for such other critical need of an individual. If any withdrawal which is being made to the extent of 25% of employee's contribution and not employer's contribution, can be claimed as an exempt, unless without this exemption it would have been a subject matter of taxation. So with this change, I think what government is trying to, or what budget is trying to propose, that because these withdrawals are for critical need and therefore it should not suffer any tax, and it's a very welcome provision from the taxpayer's point of view. This will be over and above exemption which has been granted to the extent of 40% on closure of NPS account. So this is one very welcome change which has been proposed in the current budget. Let us look at income from house property and what it means to all of us. In case of income from house property, the change which has come and how it is impacting. So what used to happen is that every taxpayer has a house which is self-occupied or which is being let out. So every taxpayer has a choice. First house which is being acquired by him will be regarded as self-occupied. But if a person is holding more than one house, he can choose which house will be regarded as a self-occupied house. And the other house, either he can let it out. If he has not let it out, then the law has created a fiction, assuming that this is being let out, which is known as deemed to have been let out, and is being subject matter of tax on a notional rent basis. Now what used to happen is that every person who has two houses, one house where it is self-occupied, but the other house, if it has been taken on loan and interest expenditure incurred thereon, was eligible for set off against other income. Now the provision has been brought in place to make sure that the overall set off is not exceeding 2 lakhs in aggregate. What does it mean? That when a person is having self-occupied house, if that is also suffered an interest cost and another property suffering interest cost, both put together, the loss is restricted to 2 lakhs, can be set off against the current year's other income such as salary income or income from other sources. And the balance loss needs to be carried forward for next 8 years and can only be set off against income from house property. Now let me explain this through an example. So if income from salary is around 10 lakhs and loss from self-occupied property is 2 lakh and loss from let out or deemed to have been let out property is 3.5 lakh. In aggregate, the total loss is 5.5 lakh. As pre-budget, this entire loss was allowed to be set off against salary income and net taxable income was 5 lakh including income from other sources of 50,000. However, post budget, assuming this budget gets approved in a manner in which it has been proposed, what will happen that in loss which was earlier allowed at 5.5 lakh now will be restricted to 2 lakh, and therefore income will be assessed at 8.5 lakh as opposed to 5 lakhs, which would mean now the tax needs to be paid on additional income of 3.5 lakh. So this is a big change which has come in from a taxpayer perspective.
And Mayur, these 3.5 lakh, the carry forward losses can be taken for the next 8 years, but which will be set off only against the house property income.
That is absolutely correct. And after 8 years, it cannot be carried forward any further.
And while from the computing the income from the house property, what kind of the deduction generally is available for the owners of the property?
Yeah, so how to compute income from house property? The way it is, for self-occupied property, the rental value needs to be considered as nil. What you can claim is only in interest deductions therefrom. For self-occupied property, interest deduction cannot be claimed for more than 2 lakh. Provided you have appropriate certificates available from the person whom you have taken the loan. Yeah. However, as far as property which is let out or deemed to have been let out, what one needs to consider either actual rent received or fair rent which that property can fetch. Whichever is higher is to be offered to tax. From that, what you have to reduce is municipal taxes paid thereon. And thereafter what happens is that from that you get an ad hoc deduction of 30%. After reducing 30% of ad hoc deductions, you can claim interest which has been paid on that property, and that's how you arrive at actual profit or loss from income from house property.
But if I incur certain expenses for maintenance of properties, then whether that can be claimed or it will be covered under the 30%?
No, so this is not separately allowed because ad hoc deduction of 30% is given. Whether you incur expenditure or not, it is allowed irrespective of that, and therefore actual expenditure incurred needs to be ignored.
Yeah.
Yeah?
Thanks.
moving on to income from capital gains. Many a times what happens that we have a gain from capital assets being sold in the market. Now, what are the tax implications thereon and what are the tax rate which needs to be paid? So, when any listed securities or equity mutual funds are being sold, currently it is not subject matter of taxation if it is being held for more than 1 year. But if it is held less than 1 year, then it suffers tax at the rate of 15% plus applicable surcharge and education cess. If there is a sale of debt fund, then if it is being held for more than specified period, it will suffer tax at the rate of 20% after considering indexation benefit. But if it is held less than specified period, that is 3 years, in such a case the applicable tax rate would be normal slab rate. Similarly, for immovable property, if it is being held for more than 3 years, considering the index cost, person needs to pay tax at the rate of 20% plus applicable surcharge, whereas if it is being held for less than 36 months, then it will be taxed at a normal slab rate. However, this budget, what it tries to bring down a change therein. The change is that now property can be held for not 36 months but for 24 months. And therefore, if property is sold after 24 months, it will be regarded as a long term capital gains, and to that extent the advantage has been provided. Now, one issue arises, or where is the planning avenue therein? The planning avenue herein is that can I claim these capital gains earned being exempt from taxation? If so, what are the mechanisms? So, to this there are several exemption sections which are available or benefits which are available provided certain conditions are satisfied. Now, if any residential house being sold and being reinvested in another residential house property, then one can claim exemption from taxation therein. Important aspect is that entire capital gain needs to be invested and not the entire consideration. However, if a gain is not arising on account of sale of property but of any other assets, and a person wants to make investment in a residential property, that is also eligible for exemption under 54F. However, there is a slight change. What happens is that entire consideration needs to be invested and not just capital gains. What if a person does not want to make investment in a residential property? In such a case, they can invest in specified bonds, but the exemption is limited to 50 lakh rupees. What should be invested? Is it a gain or a net proceeds? This says only capital gains needs to be invested and not the entire proceeds. In that situation, this entire capital gain can be claimed as an exempt or based on the calculation depending upon the investment made. One important aspect is that these do contain some limitation, some lock-in period for new property to be held. If it is being disposed of prior to the lock-in period, it could suffer tax consequences thereon. There is some important change which we have already discussed, but there are few more changes which has come in the capital gain taxation system. One which we spoke about is that property now need not be held for 36 months to claim a long term benefit, but can be held for 24 months. So, it is a very welcome change that you do not now need to hold property for 3 years to be categorized as long term capital asset. The other important change which has come in is that earlier the provision was saying that if property is acquired prior to 1481, then a taxpayer had an option to replace fair market value as on 1481 to be considered as cost of acquisition and that cost can be indexed for long term capital assets. Now, this base year from 1/4/81 has been shifted to 1/4/2001, which would mean any property which is being acquired prior to 1/4/2001, in that situation, fair market value as on 1/4/2001 can be regarded as a cost of acquisition, and that can be indexed depending upon the new index number which will be provided by the tax regulations. Now, this is a very important change which can really help many persons who are acquiring property prior to 1/4/2001. Now, the other change which has come in, we spoke about that if investments are made in certain bonds. Up till now, there were only 2 bonds which were specified. Now, few more bonds will be specified to avail the benefit. To promote a specific sector, government is going to notify several other bonds which will qualify for capital gain exemption. The other change which has come in, which one needs to evaluate depending upon various aspects, or up till now all listed security was not suffering any taxation if it is being held for more than 1 year, provided when the such securities are being sold has suffered STT at the time of sale. But what is happening now, the government has proposed that STT need not be paid only on sale transaction, but if property is acquired before 2004, after 2004, and it has to suffer STT also at the stage of acquisition. If it has not suffered STT at the stage of acquisition, then it will not be entitled to any exemption. However, they are carving out certain exception which is yet to be notified, but based on whatever discussion and memorandum which is available, it appears that when any securities which are being acquired through IPO, or it is arising on account of right issue, bonus issue or things like that, then such will be carved out through this exception, which would mean that if any listed security acquired through IPO which has not suffered STT after 1st April 2004, but being sold now with STT, then it will still be eligible for exemption from taxation.
But Mayur, suppose somebody is holding the shares which is acquired the pre-STT era, then how this will work?
So, exemption is still available for securities which were acquired pre-STT era, as there could not be any STT, and the provision clearly outlines that those are not subject matter of or those are subject matter of exemption and not carved out as an exception from the exemption.
And whether these provisions will also applicable for the ESOP or sweat equity shares, where the company is directly allotting to the shares to the employees, but and on which the STT is not paid.
So, my guess, and based on whatever discussions which has been happening and explanation being provided, I think government will try to cover this aspect in their exception areas. However, one has to see what kind of exceptions they are coming out with, and based on that one can decide. But certainly this is a burning issue, and it becomes very challenging when Indian multinational company gives these stock options to their employees overseas. So, currently the way it is, if it is being held for more than 1 year by overseas employees and they sell the shares in the open market, does not suffer any taxation. But if this is not covered within this exception, that means shares acquired under ESOP are not covered as a part of exception, even those employee will be required to pay taxes in India, and this kind of leaves a different challenges, because any capital gain arising to a non-resident is also subject matter of TDS, and therefore broker or banker who are remitting this money out, they are required to withhold taxes if this exception is not carved out.
Yes.
So, this is an area of concern. Moving on to what are the other deductions which one can plan so that taxable income can be reduced. Now, let us look at, there are three sections, 8IC, 8ICCC, where annuity or pension plan is being purchased, or contribution to NPS, which will be eligible for deduction. So, there are certain investments which are being made, such as provident fund, public provident fund, investing in national saving certificate or post office deposit schemes which are eligible for 8IC, any fixed deposit which are locked in for 5 years, unit linked insurance plan, or certain mutual funds or approved superannuation fund is eligible for deduction under 8IC, under chapter 6A section 8IC. Life insurance premium paid is also eligible for benefit under section 8IC. Other important aspect which we generally have seen being ignored is that tuition fees paid to notified institutions is also eligible for 8IC deduction, one needs to take care of. The other is repayment of loan taken from financial institutions or banks, which is also eligible for deduction under 8IC. So, one needs to keep note of all this, make sure that you have identified the investments made or insurance policy purchased or any expenditure which are eligible for 8IC. Keep a list of those documents, those information which are eligible for deduction, which can reduce your tax liability. Similarly, any annuity or a pension plan purchased from LIC or any other insurance notified insurer, that is also eligible for a deduction. Similarly, contribution made to national pension scheme by employee to the extent of 10% of salary, but if a person is a self-employed, then 10% of gross total income is also eligible for deduction under 8ICCD. Now, what it means, and there is an important change for self-employed person. So, what happens in employed person, 10% is contributed by employee and 10% is also contributed by employer. So, effectively salaried person can invest to the extent of 20%, whereas self-employed person is investing only 10%. So, in the current budget, what has been proposed, that for self-employed person, now they can invest and claim deduction in respect of 20% of gross total income being invested or contributed towards NPS scheme. However, one important aspect needs to be noted, that all these deduction under 8IC or for annuity plan or contribution to NPS, overall limit is restricted to 1.5 lakh. Apart from that, there is another deduction which is available in respect of contribution to NPS by an employee. Additional deduction is to the extent of 50,000, which is available to an to a taxpayer. The other exemption which is available for salaried employees is that employer's contribution to the extent of 10% of salary is also eligible for deduction over and above 1.5 lakh plus 50,000, and that is exempt from, or that is eligible for this deduction. Now, this is the way these 2-3 provision works and helps claiming or reducing the tax liability of the taxpayer. There are other deductions which are eligible, where medical premium paid for self and for parents, the maximum premium which is available for deduction could be 50,000, could be 60,000, depending upon the age and the kind of premium which is being purchased, kind of policy which is being purchased. The other deduction which is available, expenditure incurred for dependents for specified ailments, which is available to the extent of 75,000, and for severe disability the deduction is available up to 1,25,000. This expenditure needs to be incurred, and this has to be incurred either for self or dependent relatives. The other deduction which is available in respect of expenditure incurred for other specified ailment such as cancer and other such severe ailment. The deduction which is available could be ranging from 40,000 to 80,000. The other very important aspect which is available is that education cost has increased so much. It becomes very difficult to even fund that kind of expenditure on education. The government had come up with that how do we make sure that people do have a higher education, but there are also tax benefit being provided therein. So if the cost is funded by way of a loan from banks or other specified financial institution, such education needs to be carried out in notified institution and interest thereon is eligible for deduction up to 8 years, and such interest is eligible for deduction under 8IE. The last year another provision which has been brought in respect of interest on housing loan incurred up to 50,000. Such interest is in respect of loan taken for the tax year or for the financial year 16-17. The loan amount should not exceed 35 lakhs and the value of house should not exceed 50 lakhs. In such a case, that is eligible for deduction from the taxable income. Another which is important deduction is that many taxpayer or many individual makes donations to various charitable institutions. Certain institutions are eligible for 100% deduction, certain institutions are eligible for 50%. One important aspect which we have seen being missed out, they fail to obtain appropriate certificate from the institution whether they are eligible for such deductions or not. It is important for everyone to obtain that certification, also see the validity period, that when the donation is made the certificate is valid for that period or not. Otherwise we may lose this benefit of 8IG. So that is a very important aspect which one need to note. Now what has happened in the current budget, what has been proposed to curb cash transactions, they said that donation which is made up to 2000 is eligible in cash is eligible for 8IG. Anything in excess will not be eligible for 8IG deductions. Up till now this limit was 10,000, now it has been reduced to 2,000.
But if the donation is made in check, then there is no limit.
Yeah, if donation is made in check, there are no limits for that. Now for self-employed person, the rental expenses which are incurred are also eligible for deduction from taxable income. There are specified limit, but maximum one can claim deduction is only 60,000 rupees per annum. So there is also a deduction which is available to a person either self-employed or a salaried employee who do not receive house rent allowance is eligible for claiming rent paid as a deduction under 8IGG based on various calculation method being provided for arriving or what is the deduction which is available. The other aspect is that interest on saving account is also eligible for deduction up to 10,000. Many a times we have seen this is not being claimed as a deduction by the taxpayer. So whenever any person is earning any interest up to 10,000 is eligible for deduction under section 80 TTA.
But this saving account interest, it is applicable only for a bank, or even the post office saving will be considered for this 10,000 limit?
Post office saving interest is also considered for these deductions.
Deduction. And any deduction is available for the FD interest, because the salaried person keep on keeping some fund in the FD and they are getting the deduction.
Sure. So currently it is restricted only to saving account and not FDs.
So FD accounts will be taxable from the rupee one.
Correct, and it will not be eligible for deduction.
Deduction.
Yeah. Now other aspect is that a person who is certified to be a disabled person without incurring any expenditure, a deduction can be claimed to the extent of 75,000, and if there is a severe disability, then this limit can get extended to 1,25,000. So one needs to take care of this aspect in relation to claiming deductions, which can minimize your tax implications. The other budget highlights which I would like to highlight, I would like to discuss during this webinar are that currently the tax rate which is there for the slab 2,50,000 to 5 lakh is reduced from 10 lakh to 5 lakh. Correspondingly, rebate which is available for a person earning income up to 5 lakh has been reduced to 3.5 lakh, and the rebate which was available to the extent of 5,000 has also been reduced to half. So when the tax rate has been reduced, even rebate which is available in this respect has also been reduced for the person who is earning income up to 3.5 lakh. The other additional change which is there is that a person who is earning income between 50 lakhs to 1 crore will now suffer an surcharge of 10%, which was not there earlier. So this is another change which has come. However, a person who is earning income above 1 crore will also suffer a surcharge to the extent of 15%, which remains unchanged, and education cess and higher education cess remains at 2 and 1% respectively, and there is no change therein. The other, what will be the impact of this tax rate change? So a person earning income up to 20 lakhs, the net saving for that person is 12,500 plus 3% education cess and higher education cess. In aggregate, 12,875 is the net saving arising on account of new tax rate. Similarly, a person who is earning income between 50 lakhs to 1 crore, so let us take an example of 75 lakhs, the additional tax liability which one has to suffer is around 2 lakh, which is, so there is a liability arising on account of surcharge, but correspondingly there is a saving on account of reduction in tax rate for income between 2.5 lakh to 5 lakh. As a result, the average increase is around 9.5%. However, a person who is earning income above 1 crore, there is no change in surcharge, but because there is a change in the basic slab rate, therefore there is a net saving of 14,806 rupees for them. This is on account of reduction in the rate of 10% to 5% plus surcharge on that and education cess thereon. So there is a net saving for a person who is earning income above 1 crore. Now the other aspect which has come in is that unlisted securities where the it is being sold in the sold by the person. However, many a times what we have seen, these unlisted securities are sold at a lower price than the fair market value. What used to happen up till now, the buyer used to suffer a tax if the property or shares are acquired lower than the fair market value. Now even a seller will also suffer a tax thereon if it has been sold at lower than the fair market value. So now any unlisted security which is being sold lower than the fair market value, not only buyer will suffer a tax under section 56 which deals with it, but even seller will have to suffer a tax thereon. So this is a kind of a anti-abuse measures which has been taken, where buyer and seller both will suffer a tax thereon. Secondly, what used to happen is that many company used to receive gift which was not subject matter of taxation for the recipient. Now they are trying to plug this loophole and say that any person who is receiving gift of any property will be considered as income from other sources and will be subject to tax in the hands of recipient of such gift. So this is another important change which has come in. The other highlights is that if any rent paid by an individual up to 50,000 or more will suffer TDS thereon. So individuals and HUF which was not deducting any tax unless this income the person was carrying on any business and was subject to tax audit, there was no provision for them to withhold or deduct any tax. Now it is mandatory for them to deduct tax if per month rent is above 50,000 and the tax which is to be deducted at source is 5% of the rent which is being paid. So this is a new provision.
But Mayur, in this case, that individuals will not be have the tax deduction number. So how they can deduct TDS and do the compliance?
So the provision provides that they are not necessarily required to obtain any tax deduction number, and they don't have to carry out on a regular basis compliance. They can do it everything one time. So they can deduct tax one time and pay and do a compliance in relation to that without having even tax deduction number.
So in the last month of the rent payment, they can deduct the tax on the entire rent during the year and do the tax compliance.
Absolutely right. Absolutely right. Yeah. Other aspect which is there is that dividend which is being paid in or received by a taxpayer in excess of 10 lakh, the 10% tax needs to be paid thereon. Now it is very difficult for any taxpayer to gauge that how much dividend is going to be received, and therefore appropriate advance tax needs to be paid in 4 installment as specified under the law. Now there has been a relief which has been extended for such dividend. So now only last installment needs to be paid on in respect of those dividend income, and all other three installment need not be paid, and the last installment which is due is on 15th of March. So one can always pay advance tax only at the end of the year and not during the tax year. The other important change and which is happening is that when a person is required to file the return, we have always seen that if there is no tax liability, additional tax liability due, or there is no appropriate TDS has been done and therefore no return is being filed or filed at any point in time. If it is being filed after the due date, for an individual due date is 31st July, so anything which is being filed after the due date will now mandatorily suffer a payment of 5,000 as a fee for filing belated return. But if it is filed after 31st December, then this 5,000 amount will get doubled to 10,000. However, there is a relief for a person whose income does not exceed 5 lakh. This amount of 5,000 and 10,000 will be restricted to 1,000. So the mandatory fee which needs to be paid will be restricted to 1,000. So one needs to take care that whenever anybody who is under obligation to file the return, this additional cost can be avoided and that can be regarded as a tax saving.
So Mayur, for a salaried individuals, their tax has been already deducted by the employer. Still they require to file a return and do the compliance, and whether if that compliance is not done, whether they will be eligible for this fee.
Yeah, so you have brought out a very point which is very much being asked by many taxpayers, and we receive this query quite often. If all the taxes are appropriately deducted from all the income which I earn, why would I need to file the return? However, the law provides that a person whose income, gross total income before claiming chapter 6A deduction is 2.5 lakh or above 2.5 lakh, then they are mandatorily required to file the return. whether any additional tax to be paid or it is being entire tax liability is covered through TDS really does not matter. They have to pay, they have to file the return with the tax authority. The important aspect is that even if appropriate taxes has been deducted or paid and return is not filed within the due dates, then mandatory fee they have to pay of 5,000 and 10,000 if they do not file the return within the due dates.
Non-resident investor, that is the persons who are investing in the fixed deposit in India or doing the stock trading, and their tax is already deducted by the banks, whether they also require to file the returns?
So, a non-resident, if it is governed by certain chapters relating to non-resident, there is an exception carved out there. That certain non-resident where entire liability has been taken care by way of TDS, then they are not required to file the return. However, if they have any capital gains or any other income, and if it is not governed by the particular chapter, in that case it is mandatory even for them to file the return. Otherwise, they will also suffer this penalty. Yeah. The other aspect is that a person who is receiving cash more than 3 lakh rupees in a single transaction now will have to pay penalty equivalent to the amount which is being received, and therefore one needs to take care of that. If we are intending to receive any consideration in cash, that could suffer a penalty from the tax office. So these are the few changes which we thought has been brought out. There are few more changes which are there, which I believe are not very important, but let me just run it through. Like Rajiv Gandhi equity scheme, which was there, which has been withdrawn from this year onwards, so it will not be eligible for any exemption therefrom. Also, time limit for revising return has been curtailed. So there are some administrative changes which has been brought up, which may not be very material for the purpose of our discussion. However, this I have covered in the slide, so one can refer and use that thing.
Mayur, apart from the salary, the employees are eligible for the certain amenities or non-cash benefits. So what is the tax aspects for that kind of the benefit or amenities?
Yeah, so many companies do provide car facilities to their employee, or some of the companies do provide reimbursement of petrol expenses or running and maintenance expenses if vehicle is owned by the employee himself. Now there are different rules which are being prescribed to impute value for such benefits being provided by the company. Now where the car is provided by the employer, then the amount which is taxable, I think maximum amount which is eligible is around 39,400 in a year. That will be considered as a taxable value, irrespective of quantum of expenditure incurred for running and maintenance of this car. The important aspect is that car needs to be provided by the employer during the course of employment, okay, and not otherwise. Now, in respect of other reimbursement made by the employer, if vehicle is owned by the employee, in that case the exemption is limited to 39,400, and whatever reimbursement is being done is subject matter of taxation. So let us take an example that running and maintenance expenses worth 3 lakh is being reimbursed by the employer during the financial year. However, the exemption is limited to 39,400, and the balance amount 2 lakh plus will be considered as a taxable benefit and will be included for the purpose of tax as a taxable income. Similarly, when accommodation is provided by the employer, and depending upon whether accommodation is owned by the employer or taken on lease by the employer, appropriate value needs to be imputed for deriving taxable value of benefit. Yeah. So there are mechanisms, there are methods which has been provided, rules which has been provided to impute value for benefit which is being provided by the employer. Yes. And employer is under obligation to deduct appropriate taxes also on these perquisites or benefit being provided by the employer. Let us keep this house for the question answer.
Now,
Yeah.
and in fact, thank you very much, Mayur, for your wonderful presentation. In fact, it will give it has given the insight to me also for the various aspect of the tax planning, and I trust that our audience is also get the good input out from this. And we got a lot of questions on this already, and still there will be some questions now the audience can ask on the link which is provided on the webinar. So the first questions we are question we have got on the NPS. This question is from the Pratima. She is asking that how many times the withdrawal of that 25% limit is allowed from the NPS.
Yeah, so important aspect which I think I missed during the discussion was that this exemption is restricted to 3 times. However, if we look at NPS scheme, seems to suggest that a person can avail this benefit of partial withdrawal only 3 times in the lifetime of NPS.
Yeah. There is another question which say that if the assessee is in 30% slab and his landlord is say 62-year-old, then how he can claim the HRA benefit of 3 lakh rupees per annum? Whether that income, 3 lakh income will be taxable in the hands of the landlord. That might then.
Sorry, so can you just repeat the question?
The assessee is in the slab of 30% and his landlord is a 62-year-old person and he is paying the rent of 3 lakh rupees per annum to the landlord. Whether this rent will be taxable in the hands of the landlord or any compliance is required to do regarding TDS?
Yes. So see, I think the question is in respect of the landlord, whether landlord earning income up to 3 lakh and for senior citizen the income exemption limit is 3 lakh, whether that person has to pay tax on or not. I think answer to that is that since for senior citizen the threshold limit has been enhanced from 2.5 lakh to 3 lakh, he does not have to pay tax thereon, and therefore there is no tax which is being suffered by the person who is a senior citizen.
Yes. There is one question on the NPS. What is the pros and cons of the NPS? Maybe there is another schemes which is equivalent to the NPS which can be useful for the taxpayers?
So, I think in my experience what I have seen is that many companies either they put in superannuation schemes or certain people go for statutory provident fund, and now there is an NPS. Now NPS is earlier it was only for government employees, now it has been extended even to non-government employees and self-employed person. In India, social security system was not robust enough, and therefore there are so many schemes which has been launched. So first we started with an insurance company coming out with a pension products which is being used. Now we have another national pension scheme as well, which helps in terms of ensuring that post retirement for self-employed or non-self-employed person, to make sure that after retirement they have some income to earn and sustain themselves. So this NPS has been implemented from that perspective. Now which scheme is better for which person is depending upon the personal requirement of the person. However, one wants to compare from a tax perspective. So in superannuation, if contribution is made above 1 lakh, is always subject to tax. Whereas in NPS, 10% of salary is exempt from taxation. However, overall limit is 1.5 lakh. So one has to just see in the own matter whether NPS makes more sense from a tax perspective or superannuation or some other scheme. Like provident fund is unlimited as far as employees contribution is concerned, up to 1.5 lakh is anyway covered within that limit. So it depends upon the personal facts. So I don't have any preference for NPS vis-a-vis superannuation or vis-a-vis PF.
Okay. With respect to the PF, there is always confusion that whether to contribute in the PF, that is the employer will be obviously compulsory have to contribute, but VPF and PPF, these are the options are there. So what will be the tax implications on this, or how is the tax we need to save on that part?
So, VPF, what you mean by is voluntary contribution to provident fund in excess of what normally you are required to contribute to the extent of 12%. So, an individual or a taxpayer can contribute more than 12%, which will be regarded as voluntary provident fund contribution, and that any income earned thereon or any withdrawal thereafter is exempt from taxation. So, that is an advantage if you contribute through voluntary provident fund. So, that is the advantage of voluntary provident fund.
And PPF?
So, PPF, yes, it is eligible for 8IC deduction, and that also follows exempt method. So, when any interest earned on PPF is also eligible for exemption, as well as whenever it is being withdrawn, there are no taxation at that point in time. So, even PPF is better. Now, the difference between PF and PPF, that PF you have to contribute only for self, whereas PPF you can contribute for your dependent relatives as well. So, that is an added advantage, that you are having additional saving scheme for your even family members. So, and that is where I see that there is an advantage of PPF over PF.
So, in a PPF for taken in the name of the child, whether the parents both are eligible for the deduction?
Yeah, both parents are eligible for a deduction. Only one thing needs to be noted is the parent who is contributing will be able to claim the deduction. It cannot happen that one parent is contributing, but the other parent claims the deduction on account of this. So, only parent who is contributing will be eligible for deduction. However, both the parents can contribute for their children.
Okay. And the limits will be the as per the HIC.
Yeah, so limit is restricted to 1.5 lakh, which is available under 8IC. Now, also one needs to note that the PPF account itself has an overall limit per account. So, contribution cannot exceed more than 1.5 lakh for a particular account. So, it may so happen that and many times I receive query that I as a father wants to contribute 1.5 lakh, and mother also want to contribute 1.5 lakh for the same child, which is not possible because overall limit is only 1.5 lakh.
Okay. There is one question on the PF, whether the PF transfer to a new company is treated as a withdrawal.
So, PF from one statutory or from one employer to another employer, if it is a recognized provident fund, then it will not be regarded as a withdrawal, and it is not subject matter of tax.
Okay. The one question from the audience has come, Mr. Balaji. He is asking, now in this budget, there is a surcharge is introduced for the persons having the income over 50 lakhs. So, if the person in the bracket of 50 lakhs to 1 crore, can they have some tax planning avenues other than the ATC?
So, the tax planning avenue which has been discussed in this presentation are the only one which are available, and I think there is nothing beyond that.
Okay. On the second home, if the person is having the second home, and he is paying the housing loan interest, now what is the deduction availability for him? That now in this budget there is a cap of 2 lakh rupees set off is applicable for the house property. So, now how it's work if the person is having the second home?
So, what happens if the interest cost is incurred more than 2 lakhs, and assuming that on a self occupied property there is no interest paid. So, the interest which is available for set off is only up to 2 lakhs. Any excess which has been paid will have to be carried forward to the subsequent years, and that is only up to 8 years one can carry it forward. and whenever any taxable income arises from income from house property, then such interest can be set off in that particular year. However, it is important to note that it cannot be set off against any other income.
Okay. But the overall limit will be 2 lakh set off will be available.
Correct.
That's the one question has come from the audience. The question is that I am a salaried employee, started investing in stock in 2015. I filed a return myself. While submitting the IT return last year, I did not declare the investment in the capital gain. Can I do it for the year 15-16 and 16-17 investment in stock this year?
So, you know, if you have only made investment, I think that's and if your income is above 50 lakhs, then probably you may want to file a letter with the tax office saying that these are the investment made. But if you have realized any capital gain in that year, then probably you have to revise your return and make sure that you declare that income in that particular year and don't declare it in the current year. Because this income pertains to that year, the tax rate which will have to be applied of that year, and that is how one can correct this error which has been made, which has occurred.
One question from the audience: what is higher education for the ATE deduction, and how it has been defined?
So, higher education is being defined that if it is education is carried out in a specified notified institution, and there are circulars which are available which list down which are the institutions which are there. So, probably you may want to refer those institutions, and generally these are Indian institutions such as Mumbai University or other graduation courses or post graduation courses which are covered therein. So, and very important point is that it does not cover foreign institutions.
Oh.
And therefore, one needs to be very careful when we are looking at higher education, not necessarily it will cover institutions of other than India.
Oh. So, only the Indian institutions will be covered. That's really useful input. With regards to the tuition fees, where we get the deduction under section 80C, now with where that is restricted only for the academics or also the non-academics training like a dance, music, etc., that is also covered in the tuition fees?
No, so tuition fee herein covered are only with respect to certified institutions such as universities, schools and things like that. Though it does not clearly outline, one can take an argument that okay, others are also covered, but most likely this will become matter of debate. And generally what we have seen is that 8IC getting exhausted because of PAF, PPF and things like that. So, such precedents are not available in respect of tuition fees.
Okay. And preschools like nurseries
and
KGs, these are also
one can get it covered there as well. However, as I said, why we want to generally the limits are utilized through other means. So, tuition fees are not being generally claimed as a deduction.
Under section 80G, the donations are covered for the specified institution. Whether the political parties are covered under the 80G?
No, political parties are not covered under 80G.
Okay. There are questions coming for the dividend. What is the tax on the dividend? How it is taxed in India now?
So, dividend, and it's a very important topic, and strangely the dividend which is earned above 10 lakh is taxable only if the taxpayer is resident. So, if taxpayer is a non-resident, then he does not suffer that additional tax of 10% on dividend which is earned above 10 lakhs. So, the taxable dividend is a person who is earning dividend above 10 lakhs, and if a person is a resident, then he will suffer 10% of tax on that dividend which has been earned in excess of 10 lakhs.
Okay. And if the Indian resident is getting the dividend from the company incorporate outside India, whether that dividend will be taxable in the hands of the resident?
So, yeah, and so you know the dividend which was exempt from taxation was only with respect to domestic company and dividend which has suffered dividend distribution tax. Foreign company do not suffer any dividend distribution tax. So, position remains unchanged for them. It is taxable at normal rates and that will not be subject matter of even 10%.
Oh, so that will be incorporated, means taxable
As a normal income.
Normal income. That's all.
Yeah.
From the salaried person point of view, the housing is always a bigger decision, whether to buy a house or to rent house. How you evaluate from the tax point of view?
See, generally what I have seen is buying house or not is not been considered from a tax perspective.
Yeah.
But having this question being asked, you know, house which has been bought, in that case you get interest deductions only up to 2 lakh.
Yes.
Because it is going to be a self-occupied property. Whereas if you take a property on rent, you can claim exemption more than 2 lakhs in respect of house rent allowance. So, exemption can be more than 2 lakhs.
Yes.
So, one has to see the fact, but normally I have seen house rent allowance is always better in this situation. But I would still believe that buying house or not is not dependent on whether I am getting a tax break or not, because that is a special need, one has to consider those aspects. But from a tax perspective, I believe many a times house rent allowance is better if it is only a self-occupied house then.
But in a sense, there is any cap for this HRA reductions also, or they can claim as unlimitedly?
So, HR, there is a calculation which is available. So, there are it could be 50 or 40% of your basic salary or actual HRA or rent paid in excess of 10% which is eligible for exemption. So, assuming that house rent allowance is say 1 lakh, and based on this or say house rent allowance is 10 lakhs, and based on the calculation your exemption amount comes to around 6 lakh, then the house rent allowance which is taxable is only 4 lakhs. Whereas if you say that you have taken or you have bought a house and you have paid interest, but the interest deduction can be restricted only to 2 lakh, yes. And therefore there is a kind of, from a tax perspective, you are paying more tax if you have bought the house as opposed to occupying a rented premises.
From the medical insurance, can you just throw more light on that, how this deduction is available for the medical insurance, how the caps are there, as you covered in your presentations, but still for the benefit of audience?
Sure. So, the medical premium which is available for deduction is for self and parent. For self, it is up to 25,000 and 5,000 additional which is available for preventive health checkup. Similarly, the same 25,000 is available for parents and 5,000 for health checkup. Overall limit cannot exceed more than 30,000.
Yes.
So, the overall deduction which is available is only 60,000. However, one can see between 50 and 60 what one can do, and if you do not have parents, then it can go down to 25,000. So, it can be from 0 to 60,000.
But this is apart from that ATC deduction.
This is apart from ATC deductions, absolutely.
Above the 1 lakh.
Absolutely.
So that will be the one of the avenues for the salaried person to claim the deduction. Non-resident persons are investing in India in various avenues, maybe in the fixed deposits or in the share market. So, how they generally been taxed? What are, and if there is any avenues for them to have the tax-free income?
Yeah, so if I understand, other than salary, there are capital gains or there are income from other sources. Then capital gains are exempt from taxation if it is a listed security and if we are meeting all the conditions. Or if there are capital gains which are not listed securities but are invested in specified sector, then they are also eligible for deductions on in respect of that. As far as non-residents are concerned, interest income arising from NRE or FCNR account are exempt from taxation in India, and also certain capital gains which are exempt from taxation in India. So that is what is available for non-residents.
Yeah. There are some queries from audience. There is one query from the audience. Mr. Pratik is asking, I want to provide the cash gift to my wife amounting to 15 lakhs. What is the procedure to do the same? Is it taxable in any way?
Sure. So, gift made to a relative is not taxable in the hands of recipient and not taxable in the hands of payer. However, one needs to take care that if this cash gift which is being made is being invested and earned any income therefrom, will be regarded as income of the person who is gifting this. So, if Pratik is gifting it to his wife and wife say makes an investment and earns income therefrom, then that income will be considered as Pratik's income and will have to be offered to tax by Pratik himself, as if income is earned by him, and this is arising on account of clubbing provisions which are there in the income tax law. So this is how the taxation system will work in respect of gift. So first, gift made is not subject matter of tax. However, income earned from this gift which is being invested, then such income is taxable in the hands of the donor.
So if this income is been invested in say fixed deposit, the resulting interest on fixed deposit will be taxable in hands of Pratik.
Absolutely right. Absolutely right.
There is one more query. I have 3 BHK house. Can I say I have 2 rented rooms to my family members and balance occupied by me?
See, one has to look at this has to be a genuine transaction. And in the starting only we discussed whether we want to do a tax avoidance or evasion, and by structuring like this, and if it is not a genuine transaction, then this could be construed as tax avoidance.
Yes.
So therefore, I would not recommend unless it is a genuine transaction.
In case of the HRA, suppose if I take the 2 adjoining flat on a rent for my self accommodation, can I claim the HRA for the both flats?
So if both the flat which has been taken on rent is considered as one unit for occupation, then certainly one can argue that both are eligible for HRA exemption. However, one has to really look at the facts little deeper into it, such as just to give you an example, that there is only one kitchen for both the houses and it is not separate. The other house is used only for say residing at night, and it is being used as only one unit, though there are no connection. It is always advisable that these houses are internally linked, but somewhere this matter can be challenged by the tax officer and you may get into a trouble. But certainly the fact pattern needs to support that it is being used as one unit. In that case, it is a strong case to say that I am entitled for HRA exemption. Rent paid for both the houses is entitled for exemption.
Okay. While distinguishing between the HRA and buying the house, can I have the both benefit of the HRA also and housing property housing interest also?
So there is a possibility. Let me give you an example in which situation it is possible. So what happens is that a person is working at a place which is where he is not bought any house. So many a times we have seen in service industry, a person is residing or hometown is different from the working place, and to work at a particular place he takes a accommodation on rent while he has taken a house in hometown. In such a situation it is possible to claim HRA benefit as well as you can take a interest benefit on account of self occupied or laid
in the
out
case
property.
of a transfer, these positions are possible where both the benefits can be
Absolutely, but it depends upon the circumstances. So it is not that everyone will be able to claim. One has to really look at the facts and then decide whether they are eligible or they are not eligible.
And one more query is come from the audience. Can I pay the interest on deposit at the time of the receiving? Have made the deposit in the cumulative schemes.
So can I just read this query because I have not
Yeah,
been
please,
able to
sure.
understand. Can I pay interest on deposit at the time of receiving? Have made deposit in cumulative. So what I understand the question seems to be that I have made some deposit where I am earning interest, but that has been made out of borrowed fund. And in such a situation, interest can be claimed as a deduction while offering income to tax.
Yes. So any deduction is available for the interest.
Yeah. So if and this there is a typical issue in terms of any income which is being offered as income from other sources. If any expenditure which is earned to earn income from other sources, and if it is only directly related to earning that income, then only it is eligible for deduction, but not otherwise. Right?
The family pensions received by the person, whether this will be taxable as a salary or it will be other sources income.
So if it is earned by the family member as a family pension or annuity, it will be taxed as income from other sources, and there there is a mechanism provided how do you determine taxable amount, and one has to offer it as income from other sources.
Yeah.
Yeah. I think the other question which is arising that when I have earned any income, and if the deposits are fixed deposit, which is cumulative fixed deposit for say 3 years, 4 years, 5 years, in which year I should offer income to tax?
Yes.
Now the issue is that what method of taxation I am following. If I am following method of taxation that as and when I receive I will offer it to tax, then only when I am finally that fixed deposit gets matured, at that time I will offer it to tax. But if I am saying no, I am offering income on an accrual basis, in such a case whenever that interest is due and will be reinvested, at that time it will be considered as subject matter of taxation.
In this situation, when the bank is deducting the tax on FD on the accrual basis, can I adopt then the cash basis when I will receive the interest I will offer for a tax, where my tax is deducted on the accrual basis on the year to year?
Yeah, so bank would not have a leeway to deduct on a cash basis. Bank has to deduct whenever it is being credited to that particular fixed deposit. However, when a person is offering income to tax, at that time he can claim this entire TDS. Even so, if this TDS pertains to the earlier period, but if income is offered in the current year, then TDS which was deducted earlier will also have to be claimed now, and it cannot be claimed earlier.
So then the year in which you will offer the income for a tax, and the same year you have to claim the TDS.
Absolutely right.
But in this particular case, my TDS is appearing under 26A statement. Can the income tax department question me saying that you are not offered for a tax in the same year?
No, it doesn't happen that way. The tax officer do understand that you are following a particular method of taxation which is permitted under the law, and you have been consistently following this. Therefore, the tax officer is bound to give you credit in the current year and not in that year.
Right.
And there is a specific provision under the law which says that you have to give a credit in the year in which income is offered to tax. Yeah.
In the current budget, there is a provision is that on the restriction of the cash expenses more than the 3 lakh rupees. Now, this restriction on the payer or on the receiver?
So the situation is that the penalty will be levied on the recipient. So payer may want to pay, but if receiver receives it, then he will have a challenge.
Okay.
So the penalty which is outlined in the budget is on the recipient and not on the payer.
Yes. There is one more query from the audience. If I wanted to use 1 lakh rupees for investment in a year, any recommendation on how split across the SIP, equity, mutual fund?
See, as far as split is concerned, I would say it is an investment decision and not from a tax planning perspective. It depends upon the risk appetite of an individual, and it has to be considering your personal finance planning and your ability to take appropriate risk. So if I look at, I am very conservative in my approach, I would definitely go for government securities or say SIP. But say if I look at my wife, she likes to be very aggressive in and very risk taking, and anyway she has taken a risk on me. So she would go for equity. So it really depends upon your ability to take a risk, and one has to decide based on that.
So anyway, the investment has to be decided on the liquidity or the risk front first, and then the tax matters is come last.
That's right, and I think that is what we started with.
Yeah.
It's a subset of your financial or investment plan.
There's one more query from the audience. Audience is quite inquisitive of this matter, I suppose. My wife has a PAN number, but there is no income being generated on her name. Can I provide her gift of 20 lakhs through the bank and purchase a commercial property in her name?
Gifting anything to the relative does not create any tax implication per se. Even if property, the money is gifted to the wife and property purchased therefrom will not suffer any tax in the hands of recipient or the donor or the donee, given that those are close relatives. However, what happens if this commercial property is being let out and any rental income being earned thereon? Then such rental income will be considered as income of the person who has gifted this money, and therefore if you are gifting money to your wife and being invested in commercial property, if she earns rental income from this commercial property, that has to be offered to tax as your income.
Okay. One more query has come from the audience. Whether the credit for tax deducted in India can be claimed by the NRI in his house country outside India. Suppose a person is paying the taxes in India on his interest or dividend, and if that interest and taxes dividends are also taxed in his own country, can he claim that deduction?
So certainly, one has to look at the domestic tax law of the country where he is residing in currently, and if he is eligible for credit in that country, he should be getting. In my experience, what we have seen is that if income is being taxed in India as well as in home country, he normally is eligible for credit for taxes paid in India. Now, many a times what happens that TDS is being deducted, but actual tax liability could be less than the TDS which is being deducted or more than the TDS amount. So first, the person needs to determine what is the actual tax liability which is payable in India, and only that can be claimed as a credit in the home country of the person.
Yes.
So it cannot be based on TDS, but it has to be based on actual tax liability which is being incurred.
Okay. And if the situation is reversed, say a Indian resident is getting any income from outside India, on which the tax has been deducted in the foreign country, can he get that credit?
He would get, provided tax in that country is paid in accordance with the law of that land and as per the treaty, if treaty has been signed, so tax treaty has been signed by India with that country, then one will be able to claim the credit in India. However, while claiming the credit, one needs to see that the tax liability which is there in India and foreign tax credit will be limited to only that amount. It cannot exceed, and one cannot claim refund from Indian Revenue Authority, saying that I have paid taxes in say US of 50,000, but my tax liability in India is 35,000, so balance 15 you refund. That will not happen. So foreign tax credit will be limited to 35,000 in this example.
Yeah, that's so useful. So thank you very much, it's a very interactive and very much the information is passed by you is useful for our tax planning, and you have brilliantly answered to all our audience question, and this will be very useful for them also for doing the tax planning for the next financial year as well as for this year tax investments to be done. Okay, thank you very much for your contribution.
Thank you so much.